So the final component of pension expense is quarter amortization. And quarter amortization is not something that will recur on a regular basis. It will only occur when a very special condition is met. And that is when we have a quarter, which we'll define later, that is greater than the beginning balance of my OCI, AOCI gains and loss account, right? And why does this make sense? Well, because remember, whenever we are storing an unexpected return on plan assets, we don't want to include that actual return because it'll induce a lot of volatility in our pension expense figure. We don't want to lose the information. And then so we take that actual return, which is volatile, subtract off the expected return, which is what we include in pension expense, and then we get that unexpected portion, remember. So that unexpected return, we don't want to lose this information. We put that into the AOCI account so that we don't recognize that volatile piece of it right away. However, over time, we would expect the gains and the losses in this account to even out, right? Essentially, if we make a very accurate expectation with our expected return, then we won't have to worry about biasing our unexpected returns upwards or downwards. In essence, if we have gains or losses over time that equal each other out, this account should trend towards zero. Since we're talking about a PBO, right, the projected benefit obligation is really a long-term liability that is rolling. Because essentially what you're having is more people come into your firm accruing pension expense, other people exiting the firm, you're paying out pension benefits, then you have that long-term liability that'll be just consistently rolling. And so these unexpected returns over a short period of time shouldn't matter as long as they're evening themselves out, because the PBO in itself is an obligation that will grow and shrink over time and just be a looming obligation on the part of the firm. However, if the gains or losses in the AOCI account get out of whack and they build up, then we're going to have to apply a process called quarter amortization. So it's going to apply only to the unrecognized gains and losses account, that is AOCI. It is not going to apply to the AOCI prior service costs. So don't get those two confused. This has its own amortization. What triggers this quarter amortization? Well, first, we need to have a beginning balance, obviously, because the whole idea of quarter amortization is to keep the balance of OCI gains or losses down. If there's already a zero balance, we don't have to worry about keeping it down because it's already at zero. If you have a balance, that doesn't necessarily mean we're going to have to apply it. Like I said at the beginning of this discussion, it's going to depend on whether that beginning balance is bigger than the corridor. So in order to determine the beginning balance, let's talk about things that go into this account. We have the AOCI gains or loss account. And remember, this is an equity account that we're talking about, just to keep in mind overall where this fits in the bigger picture. Three things that go in there: unexpected returns on plan assets, we already talked about. Remember, the unexpected portion, that unexpected return, if it's a gain, will go on the credit side. If it's a loss, it'll build up as a debit. And the intuition here is that since we're talking about equity, in order to reflect a loss that's unexpected, we think about debits since expenses are generally debited. But notice this is a way of including this unexpected loss without it affecting net income for the time being. The second thing that will come in under the AOCI gains and losses is an actuarial change. Now, an actuarial change is something that comes from the actuary. They'll come and tell you that they had a revision in their expectations, in their models, projecting what the projected benefit obligation should be. So for example, suppose that their mortality rates on your employees have increased such that your employees are dying at an age more quickly than they had anticipated. Well, while this is at the employee's loss, this is at the employer's gain, because if people are dying at an earlier age, you don't have to pay out pension benefits quite as long. That would be what we call an actuarial gain. An actuarial gain comes from a lowering of our estimate of what we owe people, our projected benefit obligation. An actuarial loss would be, say, if the actuary came back and said your employees are living longer than expected, then we would have to pay people a longer period of time. The projected benefit obligation would have to increase because of this. And so we would record an actuarial loss. And again, we would record this loss or this gain under AOCI. And then the final component is quarter amortization. Of course, if we have an outstanding credit balance in our AOCI that is too large, then we would debit it to reduce it. Vice versa, if we had a debit balance that was too large, then quarter amortization would credit this in order to reduce it. So now we've talked about two changes to the PBO, and it's important that you keep them distinct in your mind. Remember that a prior service cost will increase the PBO over time. When this is done, this is initiated by the company itself. So we decide that we want to amp up benefits, right? If we increase benefits for our employees because we're generous or because we're making more money, then this will lead to an OCI prior service cost, which increases our projected benefit obligation. This increase in the projected benefit obligation and prior service cost represents the retroactive benefits that need to be paid, because now you're changing benefits. You have to include everyone, no matter how long they've been at the firm, for the length of time they've been at the firm. And when we amortize it, typically what we're going to do is just straight line over the average service life. Again, this is a instance of matching where we are increasing, sorry, the camera came undone for a second. We are increasing our obligation to our employees, but we want to match it over the service life of those employees, because we're going to actually expense it over that time period rather than all at once. The actuarial change, of course, comes from the actuaries, and it's an other comprehensive income gain or loss. And the treatment there is quarter amortization, which we just spoke about. So make sure you keep those two. They both increase the PBO. Actuarial changes can decrease the PBO if it is an actuarial gain. Or if it's an actuarial loss, it will increase the PBO. But before we get too far into that, I want to just show you how this would interact with the first case that we did, the Jenny case. So looking at the numbers from Jenny, we had plan assets that began at $2,400,000. We paid out benefits, so that would decrease our plan assets as we paid them out. We made cash contributions of $450,000. And now the only piece that's missing is our actual return. So if the actual return on plan assets changed to $206,000, remember what it had been before. It had been $192,000. So what changes does that make? Well, clearly this is going to increase my plan assets by $14,000, the difference in the change there. So that would come out to $2,626,000. If you look at the PBO, where it ended up, now there's not going to be any change in the PBO if we change the actual return. It's still going to be at $2,560,000. That doesn't change any of the elements of the PBO, and so we don't have any change in the balance there. Now, again, we're not going to lose the information of the unexpected return. So we have a $206,000 actual return that influenced the plan assets. We had a $192,000 expected return, and that went to my pension expense. And so the difference between those two returns becomes my unexpected return. And since we expected 192 and we actually got 206, this would be an unexpected gain. If we have an unexpected gain, then that's going to go into our AOCI gains and loss account. The account began at 0, but now we want to have an unexpected. Now we have an unexpected gain of 14,000. That now gives it a new balance of 14,000. We also have to make an adjustment in our pension expense journal entry, because remember, pension expense is actually not going to change in this transaction simply because we changed the actual return. Pension expense is only changed by the expected return. Our cash contributions won't change either. They will remain at 450,000. That is unchanged by the actual return. What does change, of course, then is our reconciliation of the pension asset and liability account, because we changed one of the components, the balance of plan assets. Remember, this started at a 0 balance, and now the new balance will be determined by the difference between plan assets and the PBO. Since we have plan assets that are greater than the PBO, we're going to have an asset of $66,000, which is just the difference between those two accounts. In order to establish that, we need to make the adjustment, which is where the journal entry will fall in. And that's how that would change the overall scope of that problem. Now, let's look at it from a sort of micro or macro view of net income, assets, and equity. So we had a net income effect. The net income effect would stem from our pension expense, but the change in the actual return did not alter our pension expense. So there is no net effect to net income because of the change in the actual return, right? There is one overall. Obviously, we record pension expense, but I'm just looking at an analysis of the change in the actual return and what that does to the problem. Our assets and liabilities, we're going to have a slightly increased pension asset because we have a greater actual return. The actual return drove an increased balance in my plan assets, and that's what gave us this different balance in my pension asset. Our equity is also going to be greater because we have an AOCI account now with a balance. Before it was a 0 balance, we put in a $14,000 balance, and that's from that unexpected gain. Notice again that we would have a net income effect from the pension expense, but we're looking at what changed because I altered the actual return. And you should be able to go through these problems and determine what a change in the different things would do to each of these components. So if I increase service costs, well, that would increase net income. It would also increase my pension liability because I would have an increase in the PBO. By itself, it would have a decrease in equity because it was affecting pension expense. And so you should be able to walk yourself through those for different components of pension problems. So now I'm going to go through dry lock, which is a case that incorporates a little bit more than the first one and gets us a little deeper into the details. We have a 2-year pension program, data on 2 years of a pension program here. January 1st, we have a projected benefit obligation of $4.2 million. And so I'll go ahead and start T accounts for those accounts because that's typically how we tackle a pension problem. So both of them are at $4,200,000. And then I typically also, just to remind myself, that I do have a pension asset liability that is a result of these two accounts. Now, it is at a $0 balance, and so I don't have to do anything with it right now. I'm looking for components of pension expense. What else do we have here? We have a discount rate of 10%. We have information about January 1st, 2016, which I don't need right now. It does say that there are prior service costs of $500,000 created, so I will be aware that they instituted this on 1/1/16, so that'll affect some of the accounts here. In 2015, I had service costs of $150,000. That's a part of pension expense. I also want to calculate the interest cost associated with the PBO. And so I take the beginning balance of the PBO, apply the effective rate of 10%, and I get $420,000. And that's my interest cost. What else do I have in pension expense? I have an expected return. That's going to be a product of the beginning balance of plan assets and the expected return on plan assets, which is 6.6%. And if I multiply that by 6%, I get $252,000. And remember, the expected return is a negative component of pension expense because you're offsetting part of your pension expense with what you expect to earn on your plan assets. Right? Any other components I have to worry about with regards to pension expense? I don't have any prior service costs. I don't have any beginning balance in my unrecognized gains or losses that's mentioned. So I don't have corridor amortization, and I don't have any prior service cost amortization to worry about, which results in a pension expense of $318,000. Now I'm going to go ahead and translate some of these items over to the PBO and the PA, because that's what's involved in the next part, is what's going to show up on the year-end 2015 balance sheet. So one thing that's certainly going to be present is going to be the pension asset liability. To solve for that, we need to fill in and reconcile the PBO and the plan assets. We increased service cost. That's going to up our obligation. Interest costs will up our obligation. What else do we have here? We have benefits that are paid. When we pay out the benefits, that'll decrease our obligation to our employees because we're paying them out. For our plan assets, when we pay benefits, we're paying them out of that fund, and so that decreases it. When we contribute to that plan, we're putting money in the piggy bank, right? Kind of think of the plan assets as a big piggy bank that we take money out of to pay our employees. We put money into, hoping to earn that return. Speaking of that return, it's $252 on the plan assets, which matches our expected return. So because the expected and the actual return are equal, 252, which is our actual return minus the 252 expected return, then we have no unexpected return. So we have no increase to an AOCI gains or loss account. Don't have to worry about recording that piece of information. After we do that, then we can total these guys up because that looks like all the components I need. That turns to $4,392,000 of plan assets and $4,570,000 of obligation at the end of the year. Taking the difference between those two accounts, $4,570,000 and $4,392,000 gives me $178,000. This is an underfunded plan because the PBO exceeds the plan assets. Since it's underfunded, that means I'm going to record a credit balance of $178,000 in my pension liability. In terms of laying out a journal entry for pension expense, I didn't ask for it, but it's always good to know what's going on there, how these things end up on the books. Pension expense would equal $318,000 as calculated. The cash is always the cash contributed to the plan assets. Remember, it's exiting the firm, going into a special fund. And so that's $140,000 that is going into the plan asset account. And then the difference in this case is due to the adjustment that has to be made to the pension asset liability account, establishing that credit balance of $178,000. Now, when we go into the next year, remember, there is a $500,000 prior service cost that's created. And so that's going to influence a couple of things. You always want to make sure first that you update the PBO. So it was at a $4,570,000 balance. We're going to increase it by $500,000. That's the prior service cost coming in. Now, the other thing that this is going to do is when we create that prior service cost, it credits the PBO. And so it ends up as a debit in an AOCI account. So you got to keep track of that as well. So that's the first thing you want to do if you see a new prior service cost, because this is a one-time charge that we then amortize over the average remaining service life of our employees. So if we're looking at the pension expense, now we can start rolling through that calculation. Service cost for 2016 was $180,000, which is always going to be given to you. If it's not given to you, then you'll have other information to calculate it. The interest cost, remember, is going to be based off of this new PBO of $5,070,000. It's still a discount rate of 10%, but you need to apply it to that new balance after considering the new PSC. So that turns into $507,000 interest cost. The expected return is this time 8%, and it's going to be 8% of the beginning balance of plan assets. Plan assets is from the ending balance in the year before, $4,392,000. That prior service cost does not change our plan assets. So $4,392,000 times 8%, which is the expected return in 2016, yields $351,360. And remember, the expected return reduces pension expense because it's what we're earning on the money we contributed to our fund. Now, we do have amortization of the unrecognized prior service cost, $90,000. That is going to be recognizing some of this $500,000 in my current year's pension expense. So remember, this is an idea that we don't want to recognize the $500,000 all at once. And so we're going to parse it out a little bit at a time, amortize the balance, leaving $410 after we've recognized this amount in pension expense this year. That then comes to $425,640. Now that we have pension expense, again, just distribute the components. $180,000 for increasing the projected benefit obligation service cost. Interest cost is $507,000. And in this year, we paid out $280,000, so that reduces some of our benefits that we owe employees. Now my plan assets, remember I started with a balance of 4,392,000. I had an actual return of 260,000, so that will increase it. The actual return, whenever I record that, I always think about the expected return. So if I had an actual return of 260,000 and I had expected $351,360, then I have a huge unexpected loss. Because I expected 351, I only got 260. That leads to an unexpected loss of $91,360. I'll come back and deal with that in a second. Let me finish plan assets. If I contributed more money to the plan, then that's going to increase my piggy bank. And any benefits that I pay out, the benefits paid out are going to decrease it. The contributions to the plan were 185,000. 185 contributed, 280 paid out, leads to a balance of $4,557,000. The PBO, after you reconcile that balance, should come to $5,477,000. So you have your two balances here, which means now you can also construct your plan asset liability, or pension asset liability. It started at a balance of 178 credit. Now the difference between the PBO and the plan assets, it's still an underfunded plan since the PBO is greater than the plan assets. So $5,477,000 of a PBO less the $4,557,000 of the plan assets gives me a $920,000 underfunded status. Because it's underfunded by $920,000, that means that we have a credit balance we need to supply here. That would show up on the balance sheet. The $410,000 balance for the PSC would show up on the balance sheet. We have one more thing to take care of. This is $91,360 loss. Because it's a loss, remember it's going to go into my AOCI gains and loss account. And it's going to enter in as a loss, a debit, 91,360, which creates a balance of $91,360. If you were going to journalize this, you would have to remember you have a lot of moving pieces this time. In fact, you have as many as you'll ever have on a pension problem. You have your pension expense of $425,640. You have a change to your AOCI gain or loss account of $91,360. You have a change of $410,000, 0 to 410, and your AOCI PSC. You had a cash contribution of $185,000. And this is where you can use the plug to make sure that it's reconciling correctly with the work you did on your pension asset liability account. So I'm going to add up all my debits, 425,640 plus 91,360 plus 410 gives me $927,000 of debit. That means that I have to have $742,000 of credit here. I'm hoping that that's what's going to reconcile this account. If I add 742 to 178, then I get 920, and so it checks out. This is pension asset liability credit. That would complete my journal entry. So that debits equal credits. So there are a lot of moving pieces to a pension problem, and it really does hinge upon your ability to understand the difference between the balance of accounts, how the balances of accounts correlate to the balances of other accounts, and then how to supply a journal entry based on changes in the balances of accounts, right?